Inflation is where it is. This economy is growing the way he wants it to grow. Interest rates are not going to follow a predetermined path based on what a politician would like. Similarly, the exchange rate. It's the same thing. A lot of the policies that he's putting into place would strengthen the dollar, not weaken the dollar.
Telis, I feel like the weather is thought of as a really boring topic, right? You're kind of, it's not the most exciting thing to bring up in small talk.
Run out of all other small talk.
Right. But
hence
right
why
now,
we're starting this podcast with talk of the weather.
But
That's how good we are.
I think I don't know. This is like kind of all I want to talk about. I can't stop talking about how cold it is right now.
Well, certainly here in New York, it has been frigid. Like every day I look and we're talking teens to start the day. Exactly what you want for your morning.
It even impacted the inauguration, right? President Trump had to move his inauguration indoors for the first time in decades because of the weather.
Yeah, I mean, it's a market issue, right? We can joke and laugh and kind of look at pictures of, snow in Houston and New Orleans, but this quickly becomes like an actual economic issue, right? What does it mean for businesses, for consumers, for the cost of insurance, in places that are not used to having these winter storms?
Your favorite topic.
Absolutely. Well, it's a big one right now, and I think the fact that it was a big issue in Washington day one of the Trump administration just goes to show you that, the climate is going to be a hot topic.
We'll get to that in a bit, but first, let's introduce ourselves. I'm Gunjan Banerji, lead writer for Live Markets here at the Wall Street Journal.
And I'm Telis Demos. I write for the Journal's Heard on the Street column.
And this is WSJ's Take on the Week, a weekly show about money and investing.
Each week, we are bringing you conversations with insiders and from inside the Wall Street Journal's newsroom about markets, finance, business, all that good stuff. Later in the show, you'll hear a conversation that we had with Sonal Desai. She is the Chief Investment Officer for Fixed Income, what most of us call bonds, at Franklin Templeton, a major asset manager. We are talking to her about the hot topic, about interest rates, the Federal Reserve, bonds, all that stuff.
I'm excited for this one. Before that, though, let's get into the inauguration and Trump's first week back in office. It certainly was eventful.
Yes, it was. Trump's inauguration took place last week, and he didn't waste any time signing a slew of executive orders. That's typical of a new president. But in this case, there were some really, really hot topic ones. Some pertain to energy, immigration. But one thing that he did not actually kind of address in an executive order on day one is something that I think a lot of people are very excited about for the Trump administration, and that is crypto.
Well, I think his Trump meme coin and Melania's meme coin did all the talking, and he didn't even need an executive order to kind of signal this administration's enthusiasm for cryptocurrencies. And I think investors are really embracing this new regime. I was hearing a lot of optimism out there.
Well, but I do wonder, though, if part of the reason that people have bid up a lot of companies, right? Like, for example, cryptocurrency companies, your Coinbases of the world, is because they're expecting some policy changes out of Washington. And
Definitely.
So while Trump coin might be kind of a bullish indicator for a lot of people in the sort of cryptoverse, I do wonder if the stock market is going to start to wonder, okay, well, where's the actual policy stuff we're looking for? I mean, that might be forthcoming. I don't want to say it isn't. But I think to deliver on some of the hype that the market has kind of put into this administration so far, we're going to need to see that actual like brass tacks. Okay, what package of measures are you pushing for? And of course, that will also require, the Republican Congress and Senate to get in on the act too.
I was a stock market reporter in Trump's first term, and his tweets constantly moved markets. They moved currencies around the globe. They moved commodities around the globe. And of course, the U.S. stock market, as everyone tried to figure out tariffs in particular and what impact they would have on a range of companies. And I think that's still one of the biggest question marks out there. And that's going to hit the bond market in particular, right? I think that's why a lot of people are clued into what's happening with the 10-year Treasury yield. We have a Fed meeting coming up. What, if anything, will Jerome Powell, say about tariffs, the path of interest rates? And I think that's just a huge question mark right now. But I was chatting with an investor this week. He seemed to really be scratching his head. He was like, look, the stock market has run up this much. I have this pile of cash that I have not invested, and I'm looking for where to put it, particularly in the bond market. And he said, it has been one of the more difficult discussions we've ever had. This guy has been investing in stocks and bonds for decades. So he was pointing to just the tremendous amount of uncertainty there is about the path of interest rates, the policy changes that you mentioned, the tariffs that you mentioned. It all seems like a wild card right now.
And that's why I think people take bonds a little bit for granted as the kind of safe and easy part of their portfolio. And that's why I think this week's conversation that we had with Sonal Desai is such an important one for investors, because we talk about things that are risks to the bond market. After the break, we're going to have that conversation with Sonal Desai. And I want to call out, you will be surprised by some of the things she says, particularly about tariffs.
Today on the show, we have Sonal Desai, the Chief Investment Officer of Franklin Templeton Fixed Income. Sonal, thank you so much for being here.
Thanks, Gunjan and Telis. It's so lovely to be here and to talk to you guys again.
Great to have you.
So tell us, I don't know if I told you this before, but I interviewed Sonal back in 2023. I hosted kind of this bull versus bear debate on where interest rates were going to go. On one side, we had Sonal saying that she thought interest rates would stay higher for longer. On the other side, we had someone saying they thought that interest rates would go back towards zero. And that was really the popular view at the time.
I was going to say, in 2023, rates staying high was the contrarian view, right?
Exactly. And so, Sonal, I really think of you as, one of the few people who's gotten this cycle correct. So I'm really excited to have you here today.
So you know something? Every time someone says that, I say, yep, as an economist, you're only right until you are screamingly wrong. Right? But it is true that actually I've been more pessimistic about inflation, another way of saying optimistic about the US growth outlook for longer than most people.
So you're the perfect person to be chatting with right before a huge Fed meeting, the first central bank meeting of 2025. A lot of people have kind of tapered their views on how many cuts we are going to get this year. You've said we could be close to done in terms of interest rate decreases. Tell us why.
So there are different elements to this. A part of it is that you've got to start from basics. What is the famous neutral rate for the Fed? And the neutral rate is the rate at which the economy is not overheating and the economy is not moving into a dramatic slowdown. It's the rate at which the economy just keeps going. And for me, if you think that inflation were even at the Fed's 2% target, and you've got productivity which is moving in that 2%-ish zone now, that gives you a Fed funds neutral rate, nominal, of around 4%. And where are we? We're at around 4 to 4.20. We're right in that ballpark. Now, the market has for a very long time thought that rates could go a lot lower. And I think that was very much on that optimistic view of the world from the Fed perspective, which for the last 15 years has worked out, which is the Fed could easily keep on and on cutting and we never got inflation. And I think that what we're really seeing is sticky inflation and pretty strong economy. So I think that's where my 4% comes from. Are we done? Honestly, it's unclear. If we got a whole bunch of numbers, several months of numbers, like the one we got on the NFPs, our last NFPs, I think we could
the
even
non-farm
be done.
payrolls.
Yeah,
correct?
The non-farm payrolls, which is the most important labor market indicator, the jobs number, the most important labor market indicator that anybody on the street will look at. I'd say that we probably are done. They won't all look like that, but I think if the Fed were prudent, and it's been very imprudent, I'd say, when it cut by 50 basis points, I think that they would wait at least until the middle of the year, if not later, before basically saying we're done.
And when you say more numbers like that, you're referring to the fact that those numbers have been strong, indicating the economy is not being held back by interest rates, that there's still solid job creation and things like that. And so if we continue to see that, you're saying then the Fed feels like we're in that, would you call it new normal for interest rates at this level?
No, I'd call it the old, original normal, starting from the 1950s all the way to the global financial crisis.
Yeah.
There was no new normal. There was a temporary period where we had extraordinary Fed Fed policy across the world, but certainly in the US, very heterodox policy. We've had
And what would you
until
say? What period of years is that roughly? Would you say?
basically 2007, 8 through COVID.
Okay,
So
so post
until
Great Financial Crisis through the end of COVID.
end of COVID and then some, because the Fed stayed remarkably and unreasonably loose, even after inflation started picking up, even after it became abundantly clear that this economy did not need that overinflated balance sheet, those ultra low rates. The Fed was late to the game. There is no doubt about it.
What are you going to be watching for kind of at this Fed meeting when Powell is talking? What's kind of the biggest thing you're going to be watching for from him?
I think the biggest thing I'm watching for is basically for him to continue to try and claw back prudence. What do I mean by this? They cut by 50 basis points. They really didn't need to. There was no catastrophe happening that required an emergency 50 basis point rate cut. They could have done 25. The last Fed minutes seem to indicate that several Fed FOMC members were actually concerned about the incoming administration's policies, which caused them to be concerned about inflation. And I get that because indeed, potentially there are inflationary policies coming. But I would just say, against this backdrop, in 2021, President Biden came in and gave us a $2 trillion fiscal expansion, right? That was when I started saying this is going to be really inflationary. And then we followed it up with subsequent fiscal expansions. The Fed never spoke. So I would say that this is somewhat convenient to now use the incoming administration's potential policies. But, whatever works, the Fed does need a way to back its way away from the market expecting massive rate cuts. And I think that this would be one way of doing that.
So let's say this is kind of the range interest rates stay in. What does that mean for the economy? The past few years, these higher yields, these higher interest rates haven't been as bad for the economy as a lot of people initially feared. Does that start to change?
So this actually does take me back to that nominal neutral rate. If it is actually around 4%, no. Now, if you had some shock, a major shock hit the economy, then 4% would not be reasonable. And yeah, having interest rates, short-term interest rates at around 4 and a quarter, and having 10-year rates at around 5, 4.5 to 5, that would start pinging. I'd say it would start hurting somewhat. But here's the thing. Corporates over the last 3 or 4 years, much like the US recession, which never actually arrived, it was always 2 years, 1 year in the future, 4 quarters in the future, people would talk about the US recession to come. It's for the last 3 years that people in fixed income have been waiting for what we call the maturity wall to strike. What is a maturity wall? You have all these corporates who have borrowed at ultra low rates, but they don't borrow for 30 years, the way mortgage borrowing happens. They borrow for 5 years, for example. And everyone in fixed income markets typically worries that if you had borrowed originally at, say, 2% or 3%, and now rates are 5%, isn't this going to be a problem for this company? And that's called a maturity wall. And the assumption is that if it strikes, corporates will be in deep distress. But we've been waiting for this wall now for 3 years as well. And it hasn't happened because corporates have effectively been able to refinance. And the reason they can do that is that the underlying economy remains quite strong. And so it's a long way of saying, how does this impact the economy? It all depends on what's going on with GDP growth, what's going on with the labor market, consumption demand, all of these other factors, which right now are actually looking quite healthy. And especially if we get expansionary fiscal policy, this continues to keep that underlying economy quite robust.
But I want to pivot the conversation to the market. And Gunjan, I know you've talked so much about, we always ask, Gunjan, what's like the market story right now? And you keep saying it's the bond market and it's the sell-off in bonds that have driven up yields. And I guess I want to ask you and Sonal, is that the market sort of beginning to acknowledge your point of view, Sonal, and saying rates are going to be higher for a while. I don't want to buy a 10-year treasury that only pays me, 4%. I need more than that if rates are going to be where they are? Is the bond market coming around? Is that what's happening right now?
Gunjan, do you want to take that? But I know what I think.
No,
And
Sonal, go for it.
I'd say that, yeah, absolutely. I do think the bond market has started absorbing the fact that rates are going to be higher. Now, you know, the trick is always knowing how much higher. Because, of course, in bonds, when rates go higher, prices go down. The yield, that's what happens. So if we think about what people are doing right now, when bonds are at 4.5, bonds at 4.5 are at 4.5, 4.6, actually are yielding so much more than they were even 3 years ago. So people are getting real income from fixed income, and that's very positive.
Right. That's been good for the economy, right? Like it's been a form of stimulus for the economy, which has been fascinating.
It is, and people don't realize that because everyone says, well, no, the fiscal deficit has expanded, but most of that is interest payments, so that doesn't matter. But the interest payments come back to pensioners, they come
Right.
back to the people. And I think that that definitely has been positive for pension funds, for pension holders to actually see proper yields. Having said this, why, when rates are at 4.5 and so many people are sitting in cash or in the at the short end, why aren't they all piling into 4.5, 4.6 10-year bonds, driving that yield lower? Well, the reason is there is uncertainty. If inflation, and this is not my baseline is inflation doesn't change very much from where we are right now on through the end of the year, because we've been stagnant more or less on inflation for several months, and I think that continues in part because of some of the policies that we're going to see likely over the next several months. But if you expect inflation to be around that level, and there is the potential for a substantial expansion of the fiscal deficit. I say potential because we still don't have clarity as to what will actually get put in place, what this administration can put into place. All of this is true. But assume you get a fiscal deficits in line with what we've seen over the last several years, which is close to $2 trillion or even higher. All of this adds up to more issuance. You're going to see more issuance, and that takes you in the direction of what economists call term premium, which means that that 4.5, 4.6 could easily move towards 5 and could move higher. So people who are trading the bond market might lose money.
It sounds like you think this bond sell-off could get worse, and maybe we even see a 5% Treasury yield this year.
I think so. I think that that's actually so. My call at the start of last year was 10 years in the 4.5 to 5% range by the end of the year, and that was roughly where we got to. This year, I'd say I'm more inclined to think, and again, I've got something like 60 to 90 days to see what actually gets done. It's so important because there are so many policies being discussed which have immediate material impact on inflation, on the fiscal deficit, on a whole host of topics. There's deregulation, which is positive for growth. There are other factors which would
Yeah.
potentially be negative for growth, such as a massive clampdown on immigration.
Let's focus for a second on policy and just like why there's so much uncertainty or why it matters so much, what is happening at the beginning of this new administration. And I just want to bring up that, it seems like so far, the commentary from Donald Trump and some of his top economic officials, like his Treasury nominee Scott Bessent, is that their policies are not inflationary. The tariffs aren't going to cause inflation. That they're making other moves, like making it easier to produce energy and things like that. Those things are going to lower prices. Are markets just sort of not really buying that yet? Is that why we don't see people jumping into the bond market and saying, "Great, inflation's going to stay at this level"? Is that what's the market thinking about, or are they? Is there still a lot of uncertainty about that inflation question and policy question?
Number one, I actually think tariffs are a red herring. I totally agree with Scott Bessent. And the reason I think they're a bit of a red herring is tariffs are a change in relative prices. What I mean is this economy, the US, I think about it as effectively a large closed economy. What I mean by this is it's a $30 trillion economy. We import around 4 trillion. You put a 10% on 4 trillion, you've got around, what is it, 400 billion? That's nothing on the overall in the global scheme of things, this is not what is giving you inflation. Just saying. So tariffs to me may be, if the worst case scenario gets put into place, the price level as opposed to relative prices could go up by 0.4, 0.5%. Sure. We go from about 3.2 to closer to 3.5. Is this catastrophic? Well, we're coming from 9 plus. So overall, it's not something which is going to derail anything. And finally, on tariffs, it's a change in levels and then it fades. Tariffs, in the end, if you take away the tariffs name, it's a sales tax, a retail sales tax. It's not a particularly efficient sales tax, a consumption tax where the government says 5% across the board consumption, like VAT, as they charge in the euro area. Yeah, that's very efficient because people consume and you charge it on everything. I go back to what I said. Tariffs they only apply to a tiny fraction of people's consumption. There's an absolute limit on how much you can raise, and they're incredibly easy to avoid. You just don't buy that stuff.
So, Sonal, it sounds like, despite the prospect of even higher yields this year, maybe the Fed is done, maybe we see these tariffs. It sounds like you think that the economy could still keep chugging along and that these factors won't be this huge hit to growth that a lot of investors kind of feared.
Yeah, no, I actually did not fear the hit to growth from these. But going back to what does give me pause on inflation, I do think that depending on how immigration is implemented, I see how it's implemented, because while immigrants, undocumented immigrants, do actually contribute to employment in this country and they consume, and all of this adds to demand. Now, depending on how you do it, again, let's take the extreme case. People are talking about millions of deportations. Overnight, if you take out millions of people from the workforce, that will drive up wages. I'm just talking about what suddenly the people
that's
you
the hope
have.
for the policy, right? It's that some people feel like their wages are depressed by immigration. So the inflation of wages is
it's a desirable thing
built into it.
But if you're not producing more, this is exactly, yes, you're working, you're getting a higher wage, and now you can spend it. And it's not as if on the other side of things, you've suddenly got a massive increase in production.
There is just so much to watch in terms of this upcoming Fed meeting and just so much more throughout this year. But we are going to take one last break. And when we come back, we have a final question for Sonal. So President Trump recently said that he thinks interest rates are too high. Do you agree?
No, I don't.
In 30 seconds or less, tell me why.
Inflation is where it is. This economy is growing the way he wants it to grow. Interest rates are not going to follow a predetermined path based on what a politician would like. Similarly, the exchange rate. It's the same thing. A lot of the policies that he's putting into place would strengthen the dollar, not weaken the dollar. There's cognitive dissonance in wanting all of these things together. You want rates to go down, cut that budget deficit, get to that 3.33 that Scott Bessent talked about, and you might get there. But I don't see that happening this year.
Wow. Well, life in Washington, right? You want all the good and none of the bad. And that's, you can't always have it that way. Well, Sonal, thank you so much for joining us. This has been a fantastic, incredible conversation. Thank you.
Thank you so much, Sonal. This has been great.
Was so fun. This was so fun. Thanks, guys.
Oh, wow. Love to hear it. That's what we like to hear.
Fun. It's not a word we hear every day at the Wall Street Journal. I like it.